Hello, and welcome back to another video dealing with differential analysis. In this video, we are going to examine the total cost approach versus the differential cost approach. So your objectives for this video are as follows. After watching the video, hopefully you will be able to explain the difference between the total cost approach and differential cost approach in decision analysis. You will be able to apply the total cost approach. You will also be able to apply the differential cost approach. And then finally, you should be able to recite the two reasons why the differential approach is more desirable. So at first, we're going to discuss the difference between the total cost approach and the differential approach. Then we're going to go and see an example of how do we actually conduct or how do we apply the total cost approach and how do we apply the differential approach. So the total cost approach requires the construction of two comparative contribution format income statements. Okay, that means that on a sheet of paper or in a document, we're going to have two columns. We're going to have the contribution format income statement, and one column is going to show the results of our current situation. The second column is going to show the results of the alternative situation. And then we're going to create a third column that's going to have our differences. And that differential column or that differences column, we're going to use to identify the relevant costs and the relevant benefits by just looking at the contribution format income statement. Now, the differential approach, this is the most efficient way of analyzing a decision. The reason why it is so efficient is because it requires the isolation of relevant costs and relevant benefits only. Now, there are benefits of the differential approach, and the two benefits are this. First, it will be very difficult, and rarely will management be able to have enough information to prepare two detailed contribution formatted income statements for both the alternatives. Okay, that's number one. Number two says that, the differential approach doesn't blend relevant and irrelevant cost and benefits. Okay, so that's an advantage, or that's a benefit of the differential approach, because by blending relevant costs and relevant benefits and irrelevant costs and irrelevant benefits, that can be very confusing. And it takes away from the critical information, which is the relevant cost and the relevant benefit. Next, we're going to walk through an example of how to prepare the total cost approach and how to prepare the differential approach. So what we see here is an example of a decision that maybe a manager might have to make out in the real world. So we're going to conduct decision making analysis. We're going to read the facts of the case. We're going to do the total cost approach, and then we're going to look at the differential approach to making decisions. So the facts of the case are this. The Michael Scott Wood Company is deciding on whether to rent a new machine that will save on labor costs. The rental fee of the new machine is $1 million per year. This machine will be used on the company's desk-making division line. The costs below are shown on a per-unit basis. So, what we have here is our current situation, and we have our situation with the new machine. So we have alternative 1, and we have alternative 2. Also provided are the units produced and sold, the selling price per unit, the direct material cost per unit, and the direct labor cost per unit. We also have the variable overhead cost per unit, we have the fixed expense other, and then we have the fixed expense, which is the part of the fixed expense, which is the rental for the new machine. So just by looking at these, we're going to walk through and kind of get an idea of what's happening, right? Well, the units produced and sold are 2,500. Okay, we could see that they do not change under the current situation or the situation with the new machine. Okay, so alternative 1 and alternative 2, the units produced and sold are identical. They do not change. So that means that number of units produced and sold is irrelevant because they do not differ between the two situations. Next, we have the selling price per unit. We could see that under alternative 1 and alternative 2, the selling price per unit is still $12,000. It does not change. That is not a relevant cost, right? Or a relevant benefit. It's irrelevant. Look at the direct material cost per unit. The current situation, our direct material cost per unit would be $4,200. Under alternative 2, renting this new machine, the direct material costs per unit are still $4,200. Direct material is irrelevant in our decision-making process. Now look at direct labor costs per unit. We could see that currently, the current situation shows that our direct labor costs per unit are $2,400. However, under the second alternative, which is the situation with the new machine, we could see that the direct labor costs per unit drop by $900. Okay, they're $1,500. If they were $2,400, under alternative 2, they would be $1,500. That is a relevant cost. Why? Because they differ between the two alternatives. We could see variable overhead cost per unit. It is $600 per unit. It does not change under alternative 1 or under alternative 2. It's the same cost. It's the same dollar amount. That means it is irrelevant. Next, we look at our fixed expenses other. And we could see that under both alternative 1, which is the current situation, and alternative 2, which is the situation with the new machine, the fixed expenses other are identical. They're still $1,250,000. That means, regardless of whatever we decide to do, not use the machine, or let me phrase that, rent the machine or not rent the machine, we still incur fixed expense other of $1,250,000. That means that cost is irrelevant to us. Now look at the fixed expenses rental of new machine. Under the alternative 1, which is the current situation, we would not incur a rental cost. Okay, great. Under alternative 2, situation with the new machine, we could see that the fixed expenses rental of new machine would increase by $1 million. That is a relevant cost. Why? Because it differs between the two situations. If I maintain course, meaning I stick with alternative 1 and I keep producing how I've been producing with lots of direct labor, no rental of machines, I don't have that cost. If I choose alternative 2 and I decide to cut my direct labor costs and increase my fixed costs by $1 million to rent this machine, I incur the fixed cost of $1 million. It's relevant, okay? Now, next we're going to look at the total cost approach, okay? Now, this is already completed, so we're just going to look at it, okay? What does it say? Well, the first thing you should notice, and this should be a review, is that we have a contribution format income statement. How do I know that? I have my variable expenses, I have my contribution margin, then I have my fixed expenses grouped together. That's a contribution format income statement. Now, it's comparative in the sense that I have, here are my results based on If I use my current situation, which means I'm not going to use the machine, here's what my results would be. If I rent the new machine, here's what my results would be. Okay? Keep in mind, we're still looking at a contribution format income statement because we're grouping our variable expenses and grouping our fixed expenses. Okay? Now, notice we have this different column here. Okay? So, what we're going to do is we're going to look at the dollar figures under each situation. We'll look at sales. If I continue to maintain my current production, right, meaning I'm going to produce, my process is going to be identical, the same as it has been in the past. I'm not going to change anything. My sales are $30 million. If I change my process and rent this new machine, my sales are still $30 million. Okay? The number of units produced and sold did not change. The selling price did not change. Therefore, it is irrelevant. It's an irrelevant benefit. I don't even need to consider that information. Why? Because there's no change. Look at direct material costs. Under the current situation, they're $10,500,000. Under the new situation, meaning renting the machine, my direct materials are identical. I'm still going to use $10,500,000 worth of direct materials to make these desks. It is an irrelevant cost. I know that because the difference between the two scenarios is zero, so it's irrelevant. Now let's look at direct labor, okay? We already said that if we rent this new machine, our direct labor cost per unit will drop by $900, okay? Well, under the current situation, my total direct labor cost is $6 million. How did I get that? Well, I took my direct labor cost per unit under the current situation, which is $2,400. I multiplied it by the number of units produced and sold, which is 2,500 units. I get $6 million. Now, under alternative 2, which is the situation with the new machine, I could see that my total direct labor cost will be $3,750,000. How did I get that? I took the direct labor cost per unit under the new situation, which is $15,000, and I multiplied that by the number of units produced and sold, which is 2,500. That's how I got my $3,750,000. We can see that this is relevant. It's relevant because I have direct labor cost is $6 million. If I switch my processes and use the machine, my direct labor cost will be $3,750,000. I am saving on my direct labor costs. There's a difference between the two, so they're relevant. Since I'm saving on a cost, I'm saving cost, that's a benefit. So we have a relevant benefit of $2,250,000 of direct labor costs saved. Okay. Then I look at my variable overhead. Based on the current processes versus the potential new processes, they're identical. My variable manufacturing or my variable overhead is $1.5 million. It doesn't matter if I produce like I normally, the way I normally do, or if I introduce this new machine and change my production process. It's an irrelevant cost because they are identical, okay? Now, look at we're going to skip down to my fixed expenses, okay? You might be saying, well, wait a minute here, hold on. I see contribution margin differs. Shouldn't we include that? No, we should not. Here's why. We're not doing CVP analysis, okay? We learned that in a previous chapter, right? We're not worried about the difference in the contribution margin here. Here, what we're worried about is what are the relative benefits, what are the relative costs, okay? So we move down to our fixed expenses. We see that the other fixed expenses are identical under each alternative. Since they're identical, it is irrelevant. I don't need to consider it. Now, look at the fixed expense of rental for new machine. Oh, it differs, right? It differs under the current situation because under the current situation, I don't have that rental fee. However, if I change my production process, which is this alternative situation 2, I see that my rental of new machine is $1 million. That is a relevant cost. It was 0, now it's $1 million. It's relevant, okay? So then what I can do here is I could see that, okay, I went through the contribution format income statement. I looked at both relevant and irrelevant costs, and I had to make the decision. What's relevant, what's irrelevant, okay? I have a relevant benefit of $2,250,000 savings. I incur a relevant cost of $1 million. The difference between those two is $1,250,000. That means that if I select alternative 2, situation with new machine, there's a financial advantage of $1,250,000. That means that my net operating income should increase by $1,250,000. This is the total cost approach. Now, let's look at differential analysis. Okay. Remember, we're just focusing on the difference, right? We can see here that the first thing I need to do is identify what is a relevant benefit. Well, there's a decrease in my direct labor cost, okay? I'm still, regardless of the situation, I'm still producing 2,500 units, okay? The cost savings of direct labor is $900 per unit. All I need to do is multiply the number of units produced by my cost savings of $900, I get $2,250,000, okay? I do have a relevant cost here. There's an increase in that fixed expenses of $1 million. I subtract the two, my relevant benefit from my relevant cost. I see that my financial advantage is $1,250,000. Now, these two methods, total cost approach and differential approach, or differential approach, they are not different, okay? Meaning, we will not get different numbers, okay? The total cost approach requires us to create 2 contribution format income statements. Rarely will management be able to obtain such detailed information under each situation to prepare or to utilize, the total cost approach. Okay, that's number 1. Number 2, the total cost approach is confusing. It's confusing because it mingles relevant cost and benefits with irrelevant cost and benefits, okay? The differential analysis or the differential approach is preferred. It's much more preferred. Why? Well, as you can see, number 1, I do not have to prepare a contribution format income statement under the differential approach. I do not have to worry about finding enough detailed information to make a contribution format income statement. That's number 1. Number 2, we are not mingling relevant and irrelevant costs. We're just looking at the scenario or the decision that we have to make, and we're saying, okay, let me pull out the relevant costs, let me pull out the relevant benefits, and let me just compare what's relevant. So we just walked through an example to see how we apply the total cost approach and how we apply the differential approach. Hopefully that example or that illustration was um, allowed you to see that the differential approach is preferable approach to making a decision, right? The reason why it's so preferable is because that first, it does not mix relevant and irrelevant costs and benefits. And remember, by mixing or mingling those relevant and irrelevant items, that takes the focus away from the critical information. And the critical information is what's relevant, what differs. The differential approach, again, is a little easier in the sense that it focuses on the differences between the two alternatives, and it eliminates the need to find detailed information to be able to prepare those contribution format income statements. Okay? Excuse me. So now that we've seen the difference between the two approaches, now we're going to jump into some typical decisions that managers need to make by utilizing differential analysis. So tune back in for those videos.